The stock market is going crazy. So if you're kind of in that position, near distribution, near retirement, and you're kind of thinking, hey, I'm just going to hold my ground. I'm going to stay in the market. I'm going to stay with my money at risk. I just want to caution you to say that who is to say that this is the bottom? And there's even some retirement accounts that can give you an upfront match or an upfront bonus just to help you get a start with these accounts, which is really cool because if you've lost 10 to 13% of the market right now, guess what? There is a way that we could get you back to about break even, about the point where you started, before you did start losing money. Welcome to the Wealth Building for Dummies podcast, episode number 106. I'm Kyle Demian, and I'm joined here, as usual, with my buddy Renji Matthew. And on today's podcast, we're talking about the stock market and how the stock market is going crazy. And as we dive into the stock market, very important to know that, this podcast, this whole entire series is not intended to be any financial, legal, tax advice, simply just sharing education, information, our thoughts and our opinions, on money and other topics that are related, and especially to building wealth. So thank you guys so much for tuning in. At the day of this recording, it's Tuesday, April 8th. And that's going to be important because the stock market has been absolutely wild over the last few weeks. A lot of it is mostly coming from talks of tariffs, but we're going to talk about based on what phase you're in for your financial planning and as you're on your journey to building wealth, we're going to talk about what this volatility means for you, right? And so, Renji, I'm going to turn it over to you, and why don't you get us started just with, the different phases of, one's wealth building journey. And let's start with, people that are maybe young and have time and, how this volatility could actually be, their to their benefit, right?
I mean, when you're young, you're accumulating, right? So this is probably the best time to buy because what is it? What do they say? Buy low, sell high. So if you're young, get in now, right? Because you have so much time to accumulate and compound whatever you're investing in. So this is the accumulation period for you. Get in while it's low, and it might get even lower, but don't wait for it. We never know what the market's going to do. We can always do our best to predict it, but we never know what it actually does. So it might be the lowest it's going to get. If so, get in. It might not be the lowest. It might even go lower, but this is where, dollar cost averaging comes into play. Keep putting in a certain amount every month. That way, if it goes down, you're still capturing a good time to capture that stock or whatever you're trying to put into. Accumulation period right now for everyone that's young. Keep putting in money because it's low. You're getting it at a lower cost so that later in the future, when you're wanting to sell or when you're older and wanting to take a distribution out of it, you're going to be happy you invested now because you got in when it was low.
Oh, yeah, exactly. And Warren Buffett has a saying like to be fearful when others are greedy and to be greedy when others are fearful. And that's the exact mindset that is needed when you're young, when you're in the accumulation phase and you have time on your side, right? It'll be a totally different story when we get to the people that are in the preservation phase, within about 10 years or so to retirement, and especially for those in the distribution phase. But for now, if you're in the accumulation phase, greater than 10 years from retirement, this is an opportunity, a good opportunity,
Yep.
right? And like Renji said, dollar cost averaging isn't something we've actually talked too much on our podcast, I don't think about, but simply enough, it's picking a time interval, whether it's monthly or weekly, but consistently investing and putting your money into the stock market or into stocks or whatever you want, right? But the idea is you do it on a consistent basis that's preferably automated, and you just let it run its course over time. And the reason why that's so beneficial is because you're not emotionally picking when to buy or sell your stocks. You're just simply buying and holding for the long term. And when you do that over the course of time, you can take advantages like right now of the dips in the market and buy when the market is low and, hold on, for the long term. And so it's funny because Renji, I think we were talking before the show. You've had some people kind of reaching out to you too, but I know we both have clients, or at least people we've talked to in the past. Maybe they're not actually clients, but just friends or peers that we talk a lot about safe growth strategies and not putting your money directly in the stock market, but other opportunities for safety and tax advantages and so forth. But we have others that, it's totally okay if you put your money in the stock market, you can make, better.
It's
Like
a,
you said, Renji, nobody knows what the market's going to do. So I always tell
exactly.
people, if you want to buy your own individual stocks and everything, go ahead. Go
Mhm.
ahead and take that risk. But it's also important to understand that risk is prevalent and risk
Yeah.
is there when you go this route. So it's funny.
Mhm.
I've had people that are very, very risky reach out to me over the last few weeks, and they're kind of freaking out. They're like, "Oh my gosh, I'm losing money. It's down, it's down." And I'm telling them like, "Hey, everything's on sale. You told me your mindset was you're going to be
Yeah.
risky and put money into the stocks. Like this is the opportunity where you almost should be, doubling down." But here's the
Yeah.
thing. We don't know if it's going to go down. We don't know if it's going to skyrocket back up. But long story short, stick to a plan, stick to a process. If you're doing this for the long term, make sure you keep doing it for the long term and you don't just have this short term, this small, narrow minded focus that you're only looking at the stock market over the last 1 or 2 months, but you want to look at it over the course of years. you know and so Renji, anything else you wanted to add on for people that are like in the accumulation phase and growing money?
Just to add on to what you just said, it's like anything we've talked about before with entrepreneurship, for example. You got to stick to a plan for a while. If you try to do it for a few months and it doesn't succeed and you quit, then what was the point of even doing it, right? Like you
Yeah.
got to stick to a plan like listen to what experts are doing and saying and see if that makes sense for you. If it does, stick to that plan because stock market is an emotional ride. It's a roller coaster of ups and downs. It could be every day. But if you're always paying attention to it, it's going to make you go crazy. But it's good to know what's happening in the economy because that'll help you know. It's like, okay, should I keep putting money into this stock or should I pivot? But the overall strategy of putting in a certain amount every week or every month shouldn't change, right? The strategy of which stock you want to pick into, or if it's the S&P to be, if you're not someone that wants to go and do research on all the companies and you just want to pick an index fund, then yeah, do that. Just put a certain amount in every month and what is it? Set it, forget it, and don't look at it till you're older. And that's when we get to that point where you're older, there are other strategies you can use to safeguard what you've invested and grown, right? And so this is where one of the things we talk about, it really depends on you, what your goals are, how old you are, and where you're starting in your journey, right? Because the younger you are, put it in, you have time, you accumulate as much as you can. As you get older, when you're in your 50s and older, now you got to start thinking about, I mean, maybe earlier, but start thinking about, hey, I've grown this wealth. What do I do now? Right now, I'm getting closer to retirement. Should I protect some of it? Should I take, like, we don't tell everyone to take everything out of the market. It's all about diversification. What is your goal? What is your risk tolerance? What are you trying to accomplish? Depending on all of those answers, there's different strategies to do, right? So
Mhm.
as you get older, now there might be ways of, okay, let me put some of my money into uh, safe areas where you're not going to lose as much or lose anything at all. Yes, I still have money in the market, but as you get older, you want to make sure, okay, hey, I still have this money to live off of, right? You don't want to
Yeah.
wait till 70 and be fully in the market. And if something like what happened this weekend happens, then you might be in trouble.
Absolutely. And like you mentioned, diversification, that's the biggest part of this. And if the market concerns you and if you're scared and you're feeling nervous, like that tells us that you have too much money exposed to too much risk for your risk tolerance. And
Mhm.
that's okay, but you just need to be aware that there are also safe options out there. Whether you've got money already built up and you want to move it to safety, or you want to start a brand new account from zero and build it up, like there are safe options out there. And if you're curious, like what the general rule of thumb is for diversification, we like to follow the rule of 110, which is like basically like just a general rule saying you take your age and you subtract it from the number 110, and that gives you a general idea of where your diversification should be. So 110 minus 30, if you're 30 years old watching this, would say that you should have about 80% of your money in the stock market. And for you, that number may seem high, that may seem low. Once again, everybody has a different risk tolerance, but use this as a rule of thumb. And then as we transition over to talking about the preservation phase, and as people are getting close to retirement, keep in mind that if you're, let's use the number of 60, because most people nowadays are retiring anywhere from 65 to 70. And, this is the preservation phase where you want to preserve and protect your money that you have grown and you have accumulated over your years. And if we use a 60-year-old in the preservation phase, 110 minus 60 would tell us that your portfolio should be about 50-50, maybe 50% at risk in the market, 50% in safe vehicles where you're never going to lose any money. And that is how, you can start to set yourself up for a secure retirement. And so I've talked to a couple other people that, interestingly enough, they're in the preservation phase. They're getting close to retirement. And right now, they're kind of scared of the market. And, one thing I pointed out to them and told them is because I'm thinking of one specifically who is heavily in stocks. And the stock market crash over the last few weeks has really scared him. And he's within about 3 to 4 years of retiring. And so instead of him wanting to move anything over to protection now, he's basically said that he's just going to stay and hold where he's at, and he's going to wait for it to bounce back. And that can be one of the number one mistakes that I think some people make, is seeing it go down a little bit and just saying, oh, I'm going to hold on and wait for it to come back. And the reason I say that is most people are not aware of this, but the largest market crashes that we've had in a single year, I'm talking, 2008, the Great Recession, was about a 38, let's just call it a 40% loss, right? What most people don't realize is it does not take a 40% gain the next year to get back to break even. I think the math is about a 60% gain. And the reason being is you're having to recover from that loss and the lost money and add, earn extra interest on top of it. And so the mistake that you could make if you're in the preservation phase right now is simply just saying, oh, I'm going to wait for it to come back. The problem with that is if we did have a large market crash, like in the 40% area, you can lose more in one given year than you can ever make back in one given year. And the reason I say that is just, statistically speaking, we have never had a year that the stock market returned 60% in one given year. Meaning, if the market continues to go down, which there's no telling, you could set yourself up for having a delayed retirement, meaning you can't retire when you wanted to because you took too much risk. And this is exactly why the diversification is so key. And right now, just looking at, the last year to date so far here in 2024, as of April 8th, the S&P 500 is down about 13%. And I related this to a client yesterday, stating that while the stock market has been ugly, it has not been good for people that have been fully exposed to the stock market. But there's no telling or saying if we're done yet. And I relate this back to the year 2000, because the year 2000, the stock market was down about 10%. And for people that after the year 2000 would have said, hey, I'm just going to ride it out, I think it'll come back. In 2001, the market was down another 13%. In 2002, the market was down, I believe, another 20%. And so there was still room where those people that would have said, hey, I'm going to hold on, instead of holding on and actually gaining money and getting back to break even, they lost more and more money, which just delayed and deferred their retirement even more. So if you're kind of in that position where you're near preservation, near distribution, near retirement, and you're kind of thinking, hey, I'm just going to hold my ground, I'm going to stay in the market, I'm going to stay with my money at risk, I just want to caution you to say that who is to say that this is the bottom? And by you staying where you're at, you're making the assumption that you only think that the market's going to go up from here. And there is possibility that it could still go down. But it all comes back to diversification. Where are you at? How are you properly diversified? And there's even some retirement accounts, as you're closer to retirement, that can give you a match on your money. Just like how your 401ks, your TSP, maybe give you a 3, 4, 5% match. Some of these safe retirement accounts, as you're getting close to retirement, can give you an upfront match or an upfront bonus just to help you get a start with these accounts, which is really cool because if you've lost 10 to 13% of the market right now, guess what? There is a way that we could, get you back to about break even, about the point where you started, before you did start losing money in the market. And so, Renji, I apologize. I went on a little bit of a tangent there, but go ahead. Talk to us about the preservation phase as people are getting, within about 5 to 10 years of retirement, and what your thoughts are on people protecting their money.
Yeah, I mean, going back to something you mentioned before, the break-even burden, to keep it simple, if you have 100,000, if the market goes down 50%, you're at 50,000. Now, if the market goes up 50%, people think they're going to be back at 100, but 50%
Mm,
of 50,000 is only 25. So you're only up to 75,000. The market has to go up 100% for you to get back to 100,000. So when you're in the accumulation phase, when you're younger, that won't be as big of a deal. Yeah, you hold until it comes back. That makes sense because you have so much time, right? And not only hold, you put more in when the market's down, right? But when you're in the preservation phase, like in the late 50s and older, that might not make as much sense because how much longer are you going to hold, especially if you're 65 and you're planning to retire? Right? So if you keep holding, and like Kyle said, if what happened in 2000 happens, where the next year it also dropped, and the year after it also dropped, and you're about to retire, you might not have much left to retire on. So at that point, when you're in your later stages in life where you're getting closer to retirement, it makes sense to lock in the gains. Isn't that what they say when people make a lot of money in the stock market or when they gamble or whatever? Lock in some of the gains, right? You put in your money. Now that you've made profit, it's house money you're playing with. You're playing with a profit. Lock in some of those, get back what you did, protect that. Now play with the profits. Same thing, same example here. When you're older, hey, you've made plenty of returns. Now lock in some of that for your retirement goals, for safety, to protect it so you have enough to retire on. You could still have money in the stock market that you can take the risk on. But if you put everything in, like the gentleman Kyle was mentioning, now if you're in your late 60s and you have everything in the stock market, and if it goes down and then it continues to go down, what are you going to do? You might have to end up working another 10, 20 years, which if you're healthy, that might not be bad. But if your health is also lacking at that point, what are you going to do at that point? All the goals and the plans you had to provide for your family and the future generation, it might not happen anymore. So think about all that. When you're accumulating, yes, it's okay to take the risk. You have time. When you're older, it might behoove you to lock in some of those gains to be able to live a retirement.
absolutely. I laugh anytime anybody says the word behoove because my aunt uses it so much. It's like a family joke with us. She'll say any sentence just to put behoove into it because she likes the word. Um,
I
but
don't even know if I used it in the right phrase here or not, but
No,
it
you did.
sounded
I
right.
just haven't heard you say it before, so I was like, oh, that's too funny. Got to mention it. But exactly, and like you said, diversification. And while you're in the preservation phase, which keep in mind is you're still not retired yet. You're still working, you're still contributing and saving and boosting your savings. Um, these market fluctuations are dangerous, but they're not as bad compared to when you're retired. And the simple difference is the fact that when you're retired, you're no longer contributing, right? When you go into distribution phase, being retired, you're taking money from your assets. And sequence of returns risk is the number one risk that people have to be aware of once they get to retirement. Just meaning, now that you're retired, what sequence of returns are you going to receive? And if you receive returns in the first few years being retired that are negative and or not keeping up with inflation, not only are you losing money because of uh, uh, volatility in the markets, or just moving your money over to really really safe options that don't grow very well, but you're also taking income out. And for most people, they retire on the safe withdrawal rate and the 4% rule. So looking at the market so far this year being down 13%, 13.74% at the time of this recording, If you're retired and you're in distribution phase, not only have you lost 13% so far this year, but if you're doing what most retirees do and withdrawing 4%, you're also going to be down another 4% this year after the full year concludes. So as of right now, you're technically down 17, almost 18% on your money, and you just retired. If you had $1 million, we're talking about $130,000 gone just due to the market, and then another 40,000 or so dollars that are going to come out over the course of the year just from your withdrawals. So the stock market losses and the stock market volatility, if you just retired, can be super, super dangerous and super volatile. And for people that retired in the early 2000s, this is what they dealt with. And, the fact that we've got the history and we've kind of seen, the stock market go some of these, ups and downs before, and this type of volatility from, overvalued stock market. And I guess, these tariffs now are new. This is a new world we're entering. A lot of people have concerns about the real estate market. That could be another concern as well. There's just a lot of risks that are on the table, and everything around retirement should be risk free for you, or at least putting yourself in a position where you feel financially comfortable. And if you don't feel financially comfortable, you're probably exposed to too much risk. You've got too much in your accounts. I had a guy once that I was talking to that said he was retired and that he checks the stock market all the time, and that it makes him very, very nervous. And I told him, why do you do that to yourself? And he was like, I don't know. This is just what I've known and is what I've done the last 40 years. And I resonated with that. And I get it, because you're right. To be able to do anything for 40 years, number one, is longer than I've ever been alive. So it's something I can't quite equate or put, my mind to, right? But the fact that if you do something for 40 years, it's probably been ingrained into you, and you don't know what you don't know, right? Especially if you've been doing this the last 40 years. But it might be hard to make the switch. And we've talked about it before. We'll probably talk about it every single time we do a podcast talking about this. Everything with money, especially your own money, is emotional. And when your emotion goes up, your logic tends to go down. Just like the people that we're talking about that, are in the preservation phase, and they're like, oh, I lost some money. I'm going to wait for it to come back. They're getting emotional with their money, and their logic's going down. And we're forgetting the fact that, yes, this 13% loss hurts, but who's to say that we're done here at the 13%? What if it goes down to 30% losses? What if it goes down to 40% losses? We don't know. But the fact that you're so close to retirement, there's probably some different things that we could do. Right. So, Renji, anything else that you want to leave us with or kind of wrap us up with for today, whether it's the accumulation phase, distribution, or, in the middle at preservation as you're getting ready to retire?
I mean, as you're getting ready to retire, yes, preserve. But if you're, no matter where you are in your journey, if you're not doing something, what are you doing here? Hopefully you're here to learn, but do something to start putting aside money, especially if you're younger. Start putting aside money, because you got to think about the future. If you're older, start protecting some of that money, because like Kyle said, if you've been doing this for 40 years, and you're emotional when the market goes up and down, why are you causing yourself more stress? It's just preserve some of that for retirement. And then, yeah, not saying take everything out, but put some of it into accounts that are still IRAs but have protections and can give you those bonuses, and you can get a lifetime income that will sustain you for long term, right? If you're dependent on the 4% in the market, like Kyle said, if the market goes down, that 4% is going to look a lot less, right? So if you preserve some of that, lock in some of that gains into safe retirement plans, then and the market goes down, only a percentage of your portfolio is going down. You can take 4% out of all of the portfolio and still be fine. Right. And then there's other strategies you can use to make more money in retirement using your retirement accounts too. So there's so many different things out there. And then if you're one to watch the markets, if you want to study the stocks you're putting money into, great. If you have that time, great, do it. If you don't have that time, then maybe like index funds and something where you don't have to think about it as much. You're going with S&P 500, for example, the best companies in the world. You have a better chance of making money in that than losing, right? Yes, you will have months or years where the market's not doing well, but overall, overall index funds are good because overall it goes up, right? So there's different things to look into. Again, this is not financial advice. This is just educational. Hopefully this can help you in some way for anyone that's watching. If you're younger or older, whatever it is, thank you for being here, first off. And hopefully this was helpful to you.
Absolutely. And we'll have our, social medias linked here as well. So if you guys have any questions and if you guys would want to chat with Renji or myself, one-on-one to kind of walk through where you're at and where you're going and to see if there's any solutions that we can provide to help, let us know. That's what we're here to do. That's what we help with. And with that, thank you guys so much for tuning in to the episode. If you made it to the end, be sure to leave your questions below. Maybe we'll do a podcast just on the question. And we'd love and appreciate any feedback that you guys have. And as always, we'll see you guys on the next episode. Take care.